401k participants, welcome to our semi-annual market and investing update call. My name is Kevin McDermott. I'm the Director of Advanced Markets here at Kathmere Capital Management. I want to thank two of my colleagues, Jeff Forcino and our Chief Investment Officer, Nick Ryder, who helped us put together many of the things we'll talk about in today's presentation. Think of this as a twice-a-year update on all things investing and market related. Think of it as being smarter in 10 minutes. Just a quick hit on many interesting pieces of information and things that are really targeted to make you a better investor on your journey to retirement. Let's dive right in. This is cut into two sections. First section being saving and investing principles. When you look at what you can and can't control, I think it's really important, right? We know on the upper left that we can control how we invest, we can control how we save and we spend. What we cannot control is what the market will do, what will happen politically. We know that last year there was a lot of fear going into the election for those on both sides of how it would impact the markets. And there's certainly some things we can control is our employment, longevity, our health, just trying to trying to create as much saving power as we possibly can. I think what's important as investors, though, is that we do look and look back from almost a century of data back to January of 1926 and say, well, what has been a rewarding way to invest? We know that stocks, mutual funds, and the like that invest in great American companies over time have produced on average double-digit returns. Bonds, which is essentially lending money to large companies in the form either directly or in mutual funds, produce about half that, but nevertheless a premium to the cash. So those that were conservative and basically just had their money grow with the price of goods, the price of services. You could ask your grandmother or grandfather what a movie ticket or a gallon of gas used to cost. We know that those people were not rewarded for investing the way other types of investors were. Now, the one thing we have to understand about investing, though, and I'm not going to go into every detail here, is this gray column. See this gray column? These are investment returns since 1926, where the actual average rate of return fell in between 8 and 12% per year. Well, we know that the average rate of return investing over that time has been 10%, but you almost never get 10%. We must embrace volatility. Returns are going to be all over the map. Sometimes markets are going to do very, very well, as you'll see on the far right. Sometimes markets are not going to do that well, as you'll see on the far left, moving towards the center. But if we want to get that high single digit, maybe double digit rate of return over a very long period of time, we have to understand that rates of return are very rarely ever going to fall around that 10% number. It's the goal that the average will be around 10% by us controlling our emotions and investing over long periods of time. I think what's really important is that we have to understand the emotions that come with investing, right? This is a regular cycle of investing back from 2006. Things were great. Then that housing crisis, financial crisis began. And people thought in the beginning it was no big deal. And then there was significant amounts of despair. And many people, unfortunately, took their money out of the market at the wrong time and didn't take part in the recovery that then ensued from that point moving forward. In 2020, there was a similar theme. We saw that there was a lot of fear and a lot of despair in March and April of this year. For those that did nothing, they were rewarded, similar to this person back through the last financial crisis. This shows the difference between somebody selling at some point near the bottom and buying back later once the world has, quote, gotten better, versus someone that just withstood the volatility and sort of stuck to their long-term plan the whole time. And if you make these mistakes a couple times throughout your investing cycle, it can harm your returns. It's very key that we control our emotions as investors. It's a good slide to review. These are 4 examples of people also that had different outcomes investing. This has a lot to do with really focusing on investing as early as you can and as consistently as you can. So take consistent Chloe here that invests a good chunk of change from age 25 to age 65. She does the same thing every year, over 40 years, from wars and politics and terrorist events and pandemics and housing crisis, stuck to her guns. 6% rate of return. You can see that 96,000 grew to 393. Well, late Lydia did the same thing that Chloe did, but she started about 10 years later. She started at 35, so she invested almost as much money. as Chloe did, but because she started later, those early dollars didn't have as much time to grow, and she ended up with 201,000. Quitter Quincy, right, started 25 to 35, didn't save anymore. Ironically, certainly if Quincy kept saving like Chloe, Quincy would have had 393. But interestingly enough, Quitter Quincy almost had as much as Lydia because he or she started investing very, very young. So there's never too early of a time to invest, and there's never too late of a time. Investing at 25 is better than 35. Investing at 35 is better than 45. No matter what your age is, this is meant to show you the power of starting early. Nervous Noah is someone that did not handle their emotions very well from 25 to 65 and did not get the rate of return that Chloe did. Same amount invested, very dissimilar results, as you can see from 147 to 393. Identify yourself here. We all want to be Chloe. We all want to start saving at a very early age and be emotionally stable through good times and bad. We encourage you to do the same. A market update. Look at 2020, right? If you had fallen asleep January 1st of 2020 and woke up on December 31st, you would have thought, wow, what a wonderful year to invest. US stocks went up 18%. International stocks did fairly well. Emerging market stocks did well. Well, we all know that 2020 was anything but a great year on a great many metrics. But for those people that started the year invested and remained invested throughout the year, they saw tremendous growth in their retirement accounts. If you look to the right here, you will see that there are benefits to investing. Now, international markets have not done as well as domestic markets. I'll get to that in a minute. But the one theme I want you to understand here is that when you move from left to right, from 2020, and you look at 3-year returns, 5-year returns, these are average annual returns, by the way, that you'll see on the screen. What you can basically guarantee is that the longer the period of time, the more likely it is that T-bills and short-term bonds are going to perform very poorly. No one knows what the rest of 2021 holds, 2022. Maybe it's a good time to be in cash. Maybe it's not. But if you look at any 10-year snapshot going back to 1926, cash and short-term bonds gravitate to the worst performers. And it's something for those with a long-term time horizon we have to be very careful and take into account. This is another thing that's very important. I could talk about this slide for 5 minutes. I won't. The second quarter of 2020, this year, from April 1st until June 30th of 2020, the market went up 20.5%. That was immediately after the quarter that went down 19.5%. What's the point of this story? For you as an investor, the next time the market has a very poor quarter, if you look at these years, you're going to find a number of recovery timeframes over here. Oftentimes in the third quarter of 1974, when the market went down 25%, ironically in the first quarter of 1975, the market went up 22.9%. It's so important during very bad times to know that the sun will come up. And if your time horizon is 5 to 10 years, make sure you keep saving, make sure you take the opportunity to go buy low. And those are going to be some of the best investments you've made throughout your life. And know that oftentimes the best days in the market can come immediately after the worst days. This is something very important about 2020. You may be familiar with the term FANG, right? Which is Facebook, Amazon, Netflix, Google, some of the big tech companies. Well, in 2020, those companies did extraordinarily well. Work from home, furthering of the tech revolution. The S&P 500, which includes these companies, did about 18.4%. But the S&P 500 is weighted more towards the largest companies. So the performance of Amazon and Facebook per se have a larger impact on the actual market performance than some of the smaller companies in the S&P 500. But if you had the S&P 500 that was equal weighted, where Apple and Amazon and Netflix, these companies were not any more weighted than Exelon or Comcast or anything else, some of the companies here in Philadelphia, the market did 12.8%. So we need to be careful to think that, well, the generals are doing very well, the big mega tech companies, but many of the other companies just had okay years. Certainly years they're happy about, but not the high flying year that the tech companies had. We think in the next 10 years, certainly we want to remain diversified over the whole index and make sure that if these companies come back to earth per se, and the other companies start to lead, that you have exposure to all of them. One of the things about international markets, I'll keep this brief. This yellow column talks about the price to earnings ratio, which think about how expensive companies are trading. You'll hear people say, oh, the market's overvalued, it's overvalued. We step back from those predictions. The one thing we will show you is that based on the price of US companies, the earnings are right about in line. So the reason that companies are trading at a bit of a premium, without getting into too much detail, is because the earning projections for some of the companies I just mentioned are very, very good. In developed markets and emerging markets, you have companies that are not trading at a premium, but their earnings potential in international and emerging markets are extraordinary. Companies are saying overseas, we expect to have blowout earnings, but the stock price has not yet risen yet to reflect those earnings. We would encourage you in your 401k to be diversified globally. Some interesting statistics there. The one thing as well, and we'll close with this, is many people right now are wondering, is the market overvalued? Is the market overvalued? There is tremendous pent-up demand in our society to go out to dinner, to fly on a plane somewhere, to do anything once we're able to get out again and live the lives the way we remember living. All this talks about here is the fact that if you look to the upper left here, is that the personal disposable income did increase in 2020, meaning that people that would spend money on dinners or on vacations or on babysitters, depending on your phase of life, they weren't able to do any of those things. They were able to save some more money that was also impacted by the stimulus checks. And it's further seen over here from the personal savings rate, that if you look at the personal savings rate from 2000 to 2019, it's pretty consistent, right? And then there's this huge spike where the savings rate went up just because people couldn't spend. You see at the end of 2020, it's starting to come down again. But that savings rate, that money that's been saved, we think one of the reasons the market has great prospects to do well moving forward in the short term is because many of these companies are going to be the beneficiary of people beginning to spend money again. So I want to thank you for this. I hope you took something from this, just a little piece to make you understand a little bit more about how you're invested, ways you should think. If you have any questions about this presentation, I would encourage you to call our participant services department, call your plan advisor. There's a few of us here at Kathmere, obviously. But if you have any questions, certainly reach out to Grant Boyle. He does head our participant services department, and you can reach him via email or phone there. Thank you very much. Have a great rest of your day, and we'll look forward to talking to you soon.